Let's be real. Every time you put money into an investment, you're making a bet. You're giving up the certainty of cash today for the chance at a bigger reward tomorrow. But how do you know if you're getting a good deal? How do you know if the reward is worth the risk you're taking? Well, that single question is right at the heart of modern finance. And today, we're going to unpack it. Think about it like this. What if you could walk into an investment supermarket and every single stock, every bond, every asset had a clear, easy-to-read price tag? Not a price tag for its cost in dollars, but a price tag for its risk. A tag that tells you exactly how much extra return you should demand for every unit of uncertainty you're willing to accept. Believe it or not, that price tag exists, and we're about to find it. Okay, so to find that price tag, we have to start with the absolute basics. Every single investment really boils down to just two things. First, what's the potential payoff? In finance, we call that the expected return. And second, how much of a roller coaster ride is it going to be? That's what we call risk. Now, we've got to be super clear about what expected return means. This is not a promise. It's not a guarantee. It's really just a forecast. It's the average result you'd get if you could somehow live through the same investment 1,000 times over. You're just taking all the possible outcomes, the good, the bad, the ugly, and weighting them by their chances of happening. Let's make this concrete with a quick example. Take a look at these two stocks, L and U. We'll keep it simple. There's a 50-50 shot the economy either booms or goes into recession. For stock L, you take that awesome 70% boom return, multiply by its 50% probability, then you take the nasty negative 20% recession return, multiply that by its 50% probability, add them up, and you get an expected return of 25%. You do the same math for stock U, you get 20%. So here's what's interesting. Even with that huge potential loss, stock L's massive upside gives it a higher expected return, at least on paper. But see, that 25% for stock L doesn't tell you anything about the wild swing between plus 70 and minus 20%, does it? That's the other half of the puzzle, risk. To measure this wobbliness, we use statistical tools called variance and standard deviation. It's just a fancy way of putting a number on how spread out all the possible outcomes are. This number stands for the asset's total risk. So we can measure the return and the total risk for one single stock. Fine, but here's the thing. Nobody really invests like that, do they? We build portfolios, we combine things, and this is where something truly amazing happens. It's a concept that people often call the one and only free lunch in all of finance. So what is this free lunch? It's this. By simply combining different assets together in a portfolio, you can actually reduce the overall wobbliness, the risk, often without having to give up any of your expected return. You literally get to smooth out the ride for free. This isn't just some theory, it is the bedrock of modern investing. What we're talking about here is the principle of diversification. The magic happens when you combine assets that don't move in perfect sync. When one zigs, the other zags. Their individual ups and downs start to cancel each other out. This process lets you get rid of a whole bunch of risk, which we call, you guessed it, diversifiable risk. But there's a catch. There's always a catch, right? Some risk is just so big, so widespread, it sticks around no matter how many stocks you own. And you can see this so clearly on this chart. Just look at the risk of holding only one stock, a standard deviation close to 50%. That's huge. But now, look what happens when you build a portfolio of just 20 stocks. The risk gets cut almost in half. But then, notice how the line starts to flatten out? You hit a floor around 20%, and it doesn't matter if you add 100 or 1,000 more stocks, you just can't get that risk to go any lower. That floor we just hit is everything. It's the big clue. It tells us something incredibly important about the nature of risk itself. Not all risk is created equal. There are actually two completely different types, and once you understand the difference, it changes the entire game. And here they are, side by side. On the left, you've got systematic risk. This is the big stuff, market-wide risk. Think changes in GDP, inflation, interest rates, things that affect pretty much every company out there. This is the risk that creates the floor on our chart. You simply cannot diversify it away. Then on the right, you have unsystematic risk. This is all the company-specific stuff. A new product fails, a factory has an accident, a key executive leaves. This is the risk we can get rid of, just by not putting all our eggs in one basket. This brings us to the single most important rule in this entire discussion. It's called the systematic risk principle. And here's the punchline. The market does not reward you for taking on risks that you could have gotten rid of for free. I mean, why would it? If you choose to bet your life savings on one single company and you get wiped out by some unique event, that's on you. The only risk the market compensates you for bearing is the one you cannot escape. That's systematic, market-wide risk. Okay, so if we figured out that systematic risk is the only kind that earns a reward, well, the next logical step is, how do we measure it? We need a number, a simple score, that tells us exactly how much of this non-diversifiable risk any given stock has. And that number is called the beta coefficient. Just think of beta as the official scorecard for systematic risk. It doesn't care about the total wobbliness of a stock. Nope. It specifically measures how much an asset tends to move up or down when the overall market moves. It zeroes in on the only risk that actually matters for your expected return. And the best part is, interpreting beta is incredibly straightforward. By definition, the overall market has a beta of exactly 1.0. So if a stock has a beta greater than 1, it's more volatile than the average. If its beta is less than 1, it's more stable. And what about something with zero risk, like a government T-bill? Well, it has a beta of exactly 0. Simple as that.
All right, now we have all the pieces of the puzzle. We know the only risk that matters is systematic risk, and we have the tool to measure it, beta. With these two things in our back pocket, we can finally build that price tag for risk that we've been looking for all this time.
Now, the logic that ties this all together is just basic market competition. Think about it. In an efficient market, you can't have two assets with the same amount of systematic risk, but different expected returns. It just wouldn't last. If one offered a better deal, everyone would rush to buy it. That would push its price up, and its expected return would fall, right back in line. The market is this amazing self-correcting machine. And if you were to plot this relationship on a graph, with expected return going up the vertical axis and beta going along the bottom, all the fairly priced assets would form a perfect straight line. And we call this beautiful thing the security market line, or SML for short. This line is the price of risk, made visible for everyone to see. Now, a picture is great, but in finance, we need an equation. And the famous model that gives us the precise formula for that SML line is one of the heavy hitters of finance, the Capital Asset Pricing Model, or CAP. The name sounds a little intimidating, I know, but the idea behind it is actually incredibly simple and elegant. The CAPM basically says that any stock's expected return is just the sum of three simple parts. First, you start with the risk-free rate. That's what you get paid just for being patient, for waiting, even with zero risk. Second, you add what's called the market risk premium. That's the bonus, the extra return you get for being willing to take on the average risk of the whole market. And third, you take that bonus and you multiply it by the asset's specific beta. You're just scaling the reward up or down to perfectly match the asset's exact level of systematic risk. That's it. That's the whole formula. So, this leaves us with one last, really powerful question to think about. We've established that in an efficient market, every investment should fall right on that security market line. But what if you could find one that plots above it? What would that mean? Well, it would mean that asset is offering too much expected return for its level of systematic risk. In other words, it's a bargain. It's undervalued. And finding those few assets, well, that's the holy grail of investing. And it all starts with understanding the true price of risk.